Right guys, week 2, we're starting with profiles. That's what this entire week is going to be about. What we're going to try and do throughout the week is introduce the concept of profile, and I'm sure some of you have got a reasonable understanding, have read some books on it, have a rough idea of what a profile tries to show you. We want to try and bring this through from a basic principles side of things, how to interpret a profile. And what I've tried to do here is take a lot of the information regarding profile and make it into a more practical type methodology, a more practical approach to it. I find that a lot of things that you read about profile is very academic, very sort of theoretical, which is great in terms of understanding basic principles and understanding the logic, but you've then got to try and make this applicable, and you've got to try and use profile to provide a framework to trade within. And then what you've got to do is add an element of ultimately creativity to work within that framework. The profile is going to help you massively in understanding where a market's perhaps going to spend more time, where it might accelerate, whether a move has got more to go, whether a move is coming towards an end. But that provides you a framework. You've still then got to bring in the technical understanding, your entry and exit strategies, your order flow, to actually bring this into a coherent strategy to execute trade. Now, to start with, what we're going to do is we're going to cover some of the basic concepts. So the idea behind what a profile tries to show you, how it organizes the day, the information that you gain from looking at a market profile, and how this differs from candlesticks. We'll cover those principles, and then we're going to start moving into different day types, their implications, what different opens tell you, and how exactly a certain type of open or the beginning of a day leads to certain trades. So how to bring the shapes together to then sort of define a plan for every single day. This can be done so much easier with a profile. A candlestick, and the difference for me between a candlestick and a profile, or candlestick chart and profile chart, is candlestick charts ultimately provide a never-ending string of data points without really organizing them. You kind of move along this road of data and track along what's happened here, there, and everywhere. But it doesn't really give you an idea of where it's happened, what's happening, where people really want to be trading. And this is what a profile does for you. It gives you a greater sense of organization within the day. So, main kind of basic things we want to try and cover over this early part of the week, and then we're going to move more into strategies and hypothesis development as we move into the later part of the week. What we're trying to do ultimately is organize the day. You're trying to organize what's happened in terms of time and value rather than just a sequence of prices. Because what's really easy to do is see that prices have moved from here to here and be able to say, okay, well, that was a strong day. But the way in which they've done that tells you a much bigger story as to whether this really is a strong day. Because what a candle does for you is it pinpoints, particularly an open to a close, 2 data points. And then you deduce strength from the relative difference between those 2 points. But what's much more important is how you've got there and where the majority of trade has actually happened. And this is what a profile does. It organizes things in terms of time and volume. If you spent a great deal of time towards the low of a range and then closed at the very top, does that really suggest that this is such a strong move? Or is this more of a kind of, ultimately is a snapshot in time of where the market's got to? And given more time to trade, you may well not be able to sustain those prices. So that's what it's trying to do. And in doing that, it gives you a representation of where value is. And there's a key difference between value and price. And the thing to remember here is price is an advert to trade. So somebody setting a price for something provides you an advert. Would you like to buy it at that price? Think about, you have a car, you want to sell it. You can pick any price you want. You could put $1 million for the price of your car. Now, it may not be anywhere near worth that much money, but that's an advert. Somebody might really want it and might just be silly enough to pay that. That isn't indicative of what value is, though. Value is much more of the approximate average price, what most people would be willing to trade at. Because most people who buy a car for 10 times the price, realistically, are probably overpaid for something, or there's been a forcing of that payment. Think of a situation where you desperately need a drink on a long road trip. If a drink is, a can of Coke is 2-3 times the price in a service station, the immediacy of your desire for a drink is what's going to create this willingness to pay that additional price. But that's not necessarily an indication of what good value is. That's an indication of your desperation. And so therefore, price may not be able to be sustained at those prices, because unless anybody else is willing to agree that it is the right place to be trading, the market can't stay there. So that's a crucial concept to understand. The price is an advert to trade. Value is more sustainable. And it's where value is that ultimately matters as to whether a move can sustain itself or whether a move is actually getting going. To that end then, markets gravitate towards value. If you're in value, the market is likely to stay there until people change perspective, until people's reasoning shifts, and then we will move, and then value may well be accepted in other places. So you need a change in perspective in order to do that, and a response to that change perspective. All of these things are going to become a little bit clearer, and I appreciate some people perhaps aren't grasping this straight away. As I try and illustrate this, I think it'll become more clear, and we'll start off with advert to trade in a moment. The other thing that you can grasp from a profile, which you can't tell from a candlestick, is the participants. Who's participating? Because as we talked about in the very, very early stages of the first week, different participants have different motivations to trade. And they will leave a different kind of footprint or fingerprint on a candlestick, on a profile. Different kind of shape to a profile, which indicates the prevalence of a certain participant. And what this can then tell you is how likely a move is to continue. If you have a move generated by a large, long time frame participant, this is a much more sustainable move than a move created by reactive short-term traders. And I'll cover different types of traders, different motivations and their influence on markets in a moment. And so that shape tells you so much. It's not just simply different shapes that come up. And ultimately what you're trying to do, and this is what we're going to move towards the end of the week, and bring in an exercise to coach this, to try and accelerate this, and something that I'd like you guys to try and carry forward as well over the coming weeks, is it gives you an idea of how the day is going to trade and allows you to create a clear step-by-step process for how you want to approach any day. What types of trades may be useful and important on certain days? What types of trades you can dismiss? You know, there will be certain days, you'll look at your profile and you'll think, breakout trades are not there today. There's going to be other days where the market screams, play breakouts, do not play reversal trades. And the way that the market sets about at the beginning of the day, the tipping points within it, you're going to be very able and very clear on what exactly you want to do within different parts of the day. So what you're trying to do ultimately is create step-by-step scenarios on what can happen. Right, for those of you who've not seen a profile before, this is what it shows you. So I'll run you through a few of the basic things that we're going to be talking about, basic things that you want to be understanding. What you have when you set up a profile is you have letters, otherwise known as TPOs, time price opportunities. That's a textbook way of calling it, you know, letters, TPOs, whatever you want to call them. So you have a number of letters. You then also have a volume profile as well, which shows you the volume traded at every single price within that day or within that range. Now, the way that the letters form this kind of bulge is because what each letter does is it's a half an hour period. So in sequence, you will end up with something like this. So you get the A, B, C, etc. The market will move through. And so this then shows you what the range that's covered over each period. The idea of overlapping them rather than having them sequentially next to each other is that this allows you to see where the majority of trade has taken place. And this is known as your point of control. So if you see here, every letter bar the A, so bar the first half an hour of the day, every subsequent half hour period has traded at this price, at 91.5. So that's your point of control, the point where the greatest amount of time has been spent. You also have a volume point of control, which is the price at which the greatest amount of volume has been transacted. Typically, these will line up together. You would assume that the place where the most time is also the place with the most volume. It's not always the case. Particularly now that you have 24-hour markets, they include a cash session within them. You can end up with scenarios where you have a lot of time spent in the overnight session, the out of the main hour session, in one area, followed by a directional move and volume accumulates in a different area, giving you a disparity between time and volume points of control. I would view a scenario where volume has moved to be the more important. Ultimately, as we talked about from the technical point of view, volume is the most important thing. Without volume, a market is not showing that a great deal of transaction or a great deal of action has happened. It's just showing that we've done nothing in a certain area and time will still build up there. Without volume, you've not got any kind of clarity of movement. You've not got any kind of participation in a move. So that's your point of control and your volume point of control. This is theoretically the fairest price to trade at. So what else have we got? Something that we'll come into as the week goes on is your initial balance. Your initial balance is the first hour of trade. And we'll talk about different time frames for initial balances as we go forward into the coming weeks, because you can use an entire overnight session and view that as an initial balance. For the purpose of explanation here, the initial balance is your first hour's trade. The idea behind an initial balance is this can set the tone for the day. This tells you what the early indication is, what the early participation is on the day. So that's what your initial balance will do for you. We then have a few other little bits and pieces. You have a value area, which is this little box. This is where the majority of volume on the day has been conducted. This is ultimately 70% of the volume on the day is done here. And this is done by counting outwards from the VPOC until you have covered 70% of the volume evenly in each direction. Hence why it is all sitting down here. So that's where the majority of volume is covered. You will have other things that you'll notice, and we'll talk about these more and more as we go through basic principles. You have a tail. What a tail is a situation where you have just one TPO wide. So within one half an hour period, the market has traded down here and back up, and no more time has been spent down there. You see it here a little bit clearer on the broken profile or the split profile. E prints take you down, F makes it through the low, and then moves back higher. These little dashes show you the open of each print, and the little darker red highlights show you the close of each print. So there we have the tail being formed. The tail is important because this tells you whether a move is completed or not. We'll cover this in a little while. So that's predominantly everything you need to see from a profile. As we go through this session, then it's going to become much more obvious as you see more profiles and you start to see the meaning of different things within a profile. So we've got a rough understanding of what a profile shows us. So this organizes the day and allows us to then answer three key questions. And with a profile, what you're trying to do, much like with any kind of candlestick, but the main sort of three questions that you always want to be asking yourself in a profile is, what's the market doing? How well is it doing it? And who's in control? This will tell you a lot about whether a move is going to turn, whether a move can continue, and whether the type of participation that you've currently been seeing is likely to be furthered, or whether it is indicating more what one would call uncertain or low confidence trade. This would be a situation where market is predominantly ruled by short-term traders. Short-term traders, whilst they may be confident in themselves, do not necessarily exert significant movement on the market, and so therefore create an unconfident market. And that's the difference. You have to separate the individual from the market. So how are you answering these questions with a profile? Well, what a profile is going to be doing, to answer the simple question of what the market's doing, all you're trying to do here is ask yourself, well, are we balanced or are we trending? Imbalanced. That's the simple answer, really. You're looking for whether a market is directional, whether range is expanding, or whether range is contracting. Take here, for example, if we look at these two profiles, it's got two very distinctly different looking profiles. One, much longer profile, stretched, you've got little pockets of low volume within it. This is an imbalanced, trend-looking market, followed then by a balanced market. So you can then start to combine these to understand what the market's doing. Ultimately, this is clearly a market that is moving higher. We have opened down here and closed here. That gives you a pretty big green candle on this day. And then we've opened here and closed here, which will give you a much smaller green candle. If I was to draw them, that would be how the candle looks on each day. So a nice big green candle followed by a reasonably small green candle. So market's going up. We've got that much. That's easy enough to deduce from a candlestick. Next up, you're going to be asking yourself, how well is the market doing? And this comes down to a question of value shift. Is value shifting within the move? And looking at this, one could say, yep, this looks like a pretty decent move. On this day, you look at value, and I predominantly look at value from the point of view of the volume. The dark purple is where the value area is, and value has moved up. Where's the majority of the volume? Towards the top of the day. The next day, value continues to move higher. Yes, you get an overlap, but value is higher than the value area of the previous day, which is here. So in that respect, we are still seeing a market that is doing a reasonable job of moving higher. And in order to deduce this, really what you're trying to ask yourself is, how much is value overlapping? Is value overlapping at all? The more and more overlap that you see, the more and more stagnant the move is becoming. We start seeing more days where value continues in this zone just here. This is going to start to indicate to you that this is a move that is running out of steam. It's not doing such a good job of going up. It doesn't mean it can't continue, but it needs new impetus in order to continue. So unmoved value tells you that this move is currently unsustainable and therefore can't keep on going. You can also have the converse of that, where you have unmoved value and a directional move. And I'll give you an example of this in just a moment. This would indicate a market that has moved and can't justify or sustain that move without more time spent in that area. The other question you need to ask yourself, and we'll come towards this later on in this period of basic principles, is, has the move completed? And this all comes back to tails and ledges. We looked at a tail just now, gave you that brief example of those F prints. The tail shows you if a move has ended or not. Without a tail, a move is not complete. And so that's the other side of asking yourself, how well is a job, or how good a job is the market doing? If it's a market that is moving without a tail, in a sense, it's doing a good job of continuing because it has not yet completed its movement. But equally, you can view that as a market that's been forcibly stopped if it doesn't have a tail. And finally, we're looking at who's in control. Whether you've had persistent initiative, whether the person or people that have generated this movement are likely to keep on coming. And this being a trend type move is something that would suggest continuation of movement, would suggest that this is more likely a larger time frame participant, someone who is willing and able to drive this market further. And you can also then start to ask yourself, well, based on the shape of the profile and the movement of value, you can understand whether it's a forced or persistent move. You can then also understand at what point the sort of balance of power is going to shift back. In this scenario just here, the strength remains with the buyers, and any breakout away from value should elicit a continuation move. Balance is only going to switch back once you really start getting through these first set of single prints. This then puts into doubt the buying strength that got the market up here and then continue to move value up here. Now, all of these things are going to become more clear as we start moving through building from the just one day's structure to then moving it out to 2, 3, 4, mapping out the whole story of what's been happening. So they're the three main aims of a profile and what you're trying to understand. Now, one of the things that I talked about, and particularly question 3, who's in control? What I've tried to do is break down your different participants into 3 main categories. Rather than trying to sort of pinpoint the nuances between different time frame traders and the nuances between precisely different people's intent, really what you want to be thinking about is traders as a whole and what the difference is between them. So there's 3 main types. First up, you've got your short time frame traders, people like us. Now, what I've tried to do is break these down into what their intention is, what their action is, and how much influence they have. Now, short time frame traders, think about yourself. Your intent is short-term gains. Of course, everyone's intent is to try and make money. But for a short time frame trader, you're trying to make the most of different patterns within the day. Generally, you're going to be a slightly more technical trader. Very focused chart-wise, very, very knowledgeable and very focused on the nuances of what changes within the day, different patterns that you can spot within a day. You're trying to take advantage of those. Multiple trades, short holding periods. Now, because of the nature of a short time frame trader, day type trader, they're going to be more reactive to what happens. You're waiting for something to set up, you're waiting for a pattern here, a pattern there, some order flow, and you react to that. You see a market push to your level and stall, you react and you go back against that move, for example. And so one of the other features of short time frame traders is they're generally more active around extremes, because liquidity is not the important thing for a short time frame trader. It's about the likelihood or the possibility of movement. Ultimately, short-term traders are reactive or responsive traders. They can't provide the initiative drive that the market might be looking for. They have a very limited influence. They can give little bits of movement. If you lack other time frame participants, then short time frame traders can have a greater degree of impact. Typically, one of the ways that you will see this is you will see a market that does very obvious things. It's probably the best way to put it. The kind of textbook things markets do. The reaction to levels, the reaction to clear reference points within a profile. That's the kind of bit that you're looking at when you see short time frame traders. And because there's an absence of anybody else, short time frame traders will all mass into certain clear reactive trades, and that will create directional movement. So that's where they do have some influence, but on the whole, very, very limited, very mild, and it's kind of reaction from certain points. Next up, you have a medium time frame trader. Now, a medium time frame trader is somebody who is perhaps part of a small fund running some kind of longer term trading strategy. And it may be something that is more a structured strategy as opposed to just a more speculative endeavor that a short time frame trader looks for. As such, these are going to be traders who are trying to take larger scale movements. There will be a macro element, but still a reliance on the technical structures. And they're going to be willing to hold for a number of days, maybe even weeks. And trades equally may involve multiple legs, multiple aspects, multiple hedges. So it's not just as simple as, right, we're going to buy T-notes, buy T-notes. It may be a case that they're trying to buy T-notes while selling gilts, for example, or selling 5-year bonds. So there's a little bit more structure to their trades. And what will generally happen in terms of their action is they're trying to pre-position. They're trying to build up a position with the expectation of a wider movement. So a more sort of swing type trade. So they're going to use technical understanding to try and build themselves into a position with the expectation that the market will move away from this area and create the directional move that they're looking for. They do require a degree of liquidity to execute, and this is the difference between short time frame traders and medium time frame. Medium time frame traders are trying to build a large position. They ideally want the market to stay still. It's much easier, let's say, if you want to buy, if prices aren't continually changing. You can keep on putting your orders in to buy at certain prices and keep getting filled. So that they want that liquidity. They want people to offer them prices to buy and to come and sell to them in the same area. So they're going to operate within value. Now, where they have the greatest influence is not actually in their entry to trades or when their trades start to go on side and they add. But their greatest influence is typically where you get them being forced out of trades. These create what we call liquidation moves, and we'll touch on those more when we get onto day types. But what short-term traders will do is because they do have a respectable amount of size, let's say, and are generally of a more technical nature, so are generally all looking in a similar direction. When these trades go wrong, they will all run for the exits together, which can create a very clear short-term move. Now, when I say short-term, I'm thinking 2-3 hours. It could be very clear, very straight line movement as they get out of trades. This can then initiate movement from longer time frame participants as well, which then generates a further larger liquidation type movement. So they do have influence. They can also slow the market down in the accumulation phases. You look at that previous couple of profiles we had up, one directional, other balancing. They will be active in those balancing periods, building position to perhaps continue that move, to try and add on to that move in response to the drive higher that you've just seen. So that's the level of influence that they can have. And finally, you have the large, or what's known as other time frame participant. These are the people who are building portfolios, investing for the longer term, the kind of participants who may well actually want to take delivery of these goods if you're thinking commodity type markets. Ultimately, these people have a reason for their trades because they're not trying to speculate on price. They actually need the markets to facilitate their business, ultimately. For some of them, their business is trading and portfolio management. So in that respect, they will be building positions in order to try and make money from the trades themselves. But they are much more long time frame. They're basing their trade ideas on more macro events. It's more of an understanding of the wider narrative and what that implies for different markets. And they will express this in different markets. As such, technical aspects don't really matter. They're not looking at a market from a technical perspective. Their focus is on liquidity. They need other people to take the other side of their trades in order to get in. That's the key bit. As such, the market can approach a level, and if another time frame trader needs to buy and you approach resistance, the market's not going to stop. They will drive it through the level and continue to drive it in this hunt for liquidity. If somebody wants to buy, they need sellers. They need to find sellers. And so as they find sellers, they will then continually buy from those people until they run out and then drive on until they find more. So in that respect, levels are pretty irrelevant, but they have the ability to control the market. They can sustain a movement. Now, when I say control, I don't mean this in terms of a kind of manipulative or nefarious nature. I mean this from the point of view of their buying power will be persistent. They need to buy on a certain day. They will continue to buy throughout the day, and that will drive price. So they have this persistent influence. It's much less notable when they are in an accumulation phase, and if you have a two-sided other time frame trade, i.e. large time frame trader looking to sell, a large time frame trader looking to buy, market can balance. It can compress, build up positioning. And it's only really when the market moves away from that area that people require the liquidity to enter and exit trades that you really see this coming through. But it's different there to a liquidation move, that the hallmark of a other time frame liquidity hunt is much more of a trend type down. We'll distinguish between those two when we look more at day types. So that gives you an idea of the different types of participant that are active. And your job is not to precisely say, okay, that 20 lot was clearly a large time frame and that was a local and that was a medium time frame trader. Your job is to judge from the shape of the profile and the hallmarks that are left, whether a move is sustainable and what the implication of that move is for whether a market is going to turn this back or not. Right then, One of the other key tenets of profile, or something very closely associated with profile, is the concept of auction theory. Now, this goes to explain why markets fluctuate in price. And we touched on this in the early stages anyway. The whole concept of auction theory is that markets are looking to try and find the fairest price. And to that end, price will not stay very high if you can't find anybody willing to buy at those prices. Now, to try and illustrate this, what I've tried to do here is create movement of price and volume of trade, so volume at price, given by the gradient of this arrow. And then what I've got on the left is buying liquidity, selling liquidity. Buyers ultimately are going to want to buy at low prices. So there's going to be more people who want to buy down here than there are towards the higher prices. As such, as a market moves higher, so prices rise, the number of active buyers is going to fall. How many people are going to continue to be willing to pay these higher prices as the market keeps on going up? Think about this as an auction. You go to an auction, initially liquidity will be high. Lots of people may well be willing to pay the first price suggested. And as price rises, you'll still see some liquidity. Some people are willing to buy. But slowly and surely, you're going to run out of liquidity until you find the last buyer. That's the person who wins the auction in that sense. That's the last buyer up here. Now, with an auction, when you have one product, it's slightly different because that's the winning of the auction. But if you take this to the next step, what this does is this now sets a price that buyers are willing to go to. Flip this over and look at this from a seller's perspective. Liquidity of sellers is going to be high. Once the price has been established, there's going to be a lot of sellers who now look and think, okay, I know what price buyers are willing to go to. I'm now willing to sell at these prices. And lots of sellers are going to be happy to come in and sell at these prices. So you get a large amount of selling liquidity. Lots of sellers up here. They can't all get filled. They can't all trade at that price because you've run out of buyers. As such, price will then fall back because sellers now have to move their orders lower. They have to be willing to sell at a lower and lower price in order for somebody to buy from them. So what this shows you is that a market will move higher. And as you run out of buyers and you increase the number of sellers, now remember, this is liquidity. This is not necessarily trades. Because what you end up with is a lot of people wanting to sell and very few people wanting to buy, which leaves you with very little volume at the extreme. You're only going to be able to put volume at the extreme if you have a large number of people willing to buy, not just one side of lots of people willing to sell. Go back to the car analogy. If I saw somebody manage to sell their car for $1 million, I would be very keen to go and see if I could sell mine for 990,000. It's not worth that much money. I know that. But seeing as I know that somebody has paid near that or above that, I also fancy my chances at selling mine for that. And so therefore, I'm going to put it up at that price. I'm there providing liquidity. Doesn't mean I'll find a buyer. Chances are there won't be a buyer. No volume will be transacted. And I will have to reduce the price of my car to find a willing buyer. So what this suggests is that once you've run out of buyers, the market will then gravitate down until you've got sufficient buyers to match sellers. And this is why you will then end up with more volume in the middle of the range, because this is the point where sellers have been willing to reduce their price, yet not selling where the last seller is, and buyers have been willing to rise their price, yet not having to pay the highest price that has been traded. This way, you get the fairest price to trade. This is the point where the greatest amount of volume has been done. Generally, the middle of this area, the point where there is the greatest degree of agreement. And what this does is this creates your point of control. Now, the movement in the point of control is significant. Take, for example, if all of this volume was accumulated towards the top here, so you have the much darker green up here, all of the volume up here, what this would be showing you is that, in fact, buyers may well be showing a bit more control, a bit more strength, because not only are they willing to push price higher, they're still willing to trade up here. You've not found the end of the buyers because there's clearly a lot of buyers willing to meet the liquidity that is there offered from the sellers. As such, this then opens up the possibility of continuation because we've yet to find the last buyer. That's ultimately the way an auction process works. The market will bounce up and down until you find that last buyer. The more control exerted by buyers, the more value, your VPOC, your point of control, will shift higher, the more necessity to push prices higher and higher until you can find that last buyer in order to be able to say that a move has completed, that the auction is finished. So that's the kind of concept of auction theory. The market won't end a movement until you've found the last buyer or the last seller. It works similar to, for anyone who's done any economics, to a marginal pricing model where you continually rise the price until you actually find the last buyer that nobody's willing to pay a higher price than that. At that point, you've reached the kind of ideal price to sell a product at. So you can't raise price and gain new customers because they're not willing to pay higher prices. But lowering price means you're actually selling at a lower price than people would be willing to pay. Your optimal price, the maximum price people are willing to pay, whereby you maintain a number of customers. Similar kind of concept here. Okay, and so the result of all of this is that you should theoretically end up with a fair price. So you end up with this kind of bell curve distribution. You run out of buyers at extremes, sellers at extremes, and the majority of trade will be in the middle. This is theoretically your ideal scenario. Anybody who's seen any kind of bell curve distributions will understand this kind of concept. So time and volume should be evenly distributed, theoretically. And your value area comes from the middle 70%, as we've already talked about. As a result, you can't sustain movement without shifting value, as we've already talked about, and markets will move from balance to imbalance. This is a really important concept. That when markets are balanced, say if you have this type of distribution, market very, very clearly happy, everybody, buyers and sellers, are all happy with the current price. You know, everyone can agree that that's the price of that commodity or asset, whatever it is. Now, markets will imbalance. When somebody comes in and goes, do you know what? It's worth paying more for this. It's worth an extra X number of ticks, X number of dollars. People will drive price higher. If more people start to realize this, they will start, more and more people will start to buy. Look at this, in recent months, this is coming into the beginning of 2021. Recent months, we've seen price of many things influenced higher. Anything with a semiconductor in is generally seeing its price rise, particularly in a second-hand market. Now, this isn't because the quality of those products has improved. They're second-hand ones to start with. So we knew the quality when they were first bought. But what's changed is people's perspective of their value. Because you can't get new semiconductors, now the accepted value is going to shift because people's necessity to buy certain products is going to drive price, and they move to a second-hand market. As they do, price then rises. You will have sellers come in, but you're equally going to continue to see buyers coming in, and this is what shifts value. The market will imbalance, price will rise rapidly, which is what's contributed to inflation, and then there will become more acceptance of these prices. Price may not be able to stay there. If semiconductors, for example, become much more prevalent and the supply chain is fixed, all of a sudden price may well fall back down, and that perceived value up here suddenly doesn't look so good value, and people will have to sell to sort of get out of those trades, essentially. And that's how price will then fall back. As the abundance of semiconductors comes back, more and more products are going to become cheaper as there is much more access to them, and those holding those products in the second-hand market can't command such a high price for them. This can happen within a day. This can happen over the course of a couple of days, over weeks, over months. And what you're trying to do is assess that shift from an intraday perspective in terms of actually taking trades on, but then also the overall story and the overall building of value in certain areas, because this is then going to allow you to understand where perhaps the next larger, much more directional move is going to come from. The final thing, before we start getting into actually looking at examples and bringing profiles in and then trying to illustrate all of these things, one final concept is the difference between what you call initiative and responsive action. And this is what moves a market from fair prices to new prices and what enables it to stay there or not. So what we've got here then is a situation where you get some initiative followed by responsive trade and then counter-responsive trade. So let me explain. What happens with initiative action is you have large participants, other time frame participants generally. A change of perspective causes more buying. They need more liquidity. For example, if people have been buying in here and there's then a new piece of news, for example, this will generate a change in perspective. Other time frame participants need liquidity to buy, and as such, they start to buy through these prices. At that point in time, selling liquidity will disappear, the market will then drive higher. As sellers realize that, well, if somebody is rushing to buy and somebody really wants to buy, I can raise my price and raise my price and raise my price. So the market moves up nice and easy. Essentially, if the other time frame participants can't get themselves filled down here, they will then generate initiative and drive the market until they can find somebody willing to sell them, which is what they will find somewhere up here. You get responsive action. Once the price rises sufficiently, sellers are going to come in and start to sell. Now, it's not a definition of sufficiently or risen sufficiently, but what will happen is as the price rises, auction theory, you'll run out of buyers, buyers will stop continually coming in, and you'll start finding more and more sellers realizing that if they want to sell, they're going to have to perhaps lower their price in order to sell and get themselves filled. You know, it's easy as a day trader to see this from the point of view of, well, if I want to sell a 5 lot, I could sell a 5 lot anywhere in this move. If I want to sell 5,000, I'm going to find it very difficult at the top of the move, and this is the responsive action. Somebody who's got a significant amount to sell is going to realize that if they put an order in, the market doesn't come and eat that up. They can't get filled very easily. As such, they then lower their price a little bit in order to get filled. That's the responsive trade. Now, in order for a market to maintain a move, you get responsive action at the top. Sellers start to realize that they can't get filled by continually putting higher and higher offers. And then the question comes, is the responsive trade in the other way? Are buyers willing to respond here to the new prices and buy on a pullback? If so, you then end up with this bounce between responsive buyers and sellers here. This is what you call price discovery, or this phase is your price discovery. Prices rise until you discover responsive trade. Market will then bounce up and down in this area, and a fair price is re-established. A new price that people are happy to trade at becomes established, becomes accepted. This will happen maybe once a week. This might happen 3-4 times in a day, dependent upon the type of day. You know, within a move like this, there's no time frame on this. This could be something that happens over a half an hour period. This constant initiative, responsive selling, initiative, responsive selling, initiative, responsive selling. This could be something that happens over a week's worth of trade here, followed by initiative and acceptance up here. One day in the middle of 2 separate weeks, for example. But the concept is the same. And you will have it on a shorter time frame and a longer time frame, but these concepts, this drive, response, is what ultimately is going to keep a market moving or enable it to keep going. If, for example, you had this initiative, responsive trade, and then you don't get the responsive trade here, you could end up with a market that falls all the way back. So the responsive trade sends the market all the way back, resulting in a question mark as you get back there of, do you have now any response? Otherwise, you may well then start to see new sellers coming in, more initiative that's going to drive the market lower. So that's the idea of initiative versus responsive. And it's rather than trying to define who's initiating and who's responding, it's about being able to kind of understand when this is going to happen and what this implies. Okay, so I talked about an advert to trade. This is the first basic principle that I want to cover off. We're going to move through various different basic principles. So, an advert to trade. What exactly does this mean? Well, to try and explain this, what we've got here is this is a move in pound against the dollar. And what we've seen is a day where you've got nicely balanced value. There's acceptance of trade here. And so as you can see, what is happening, whilst the market is traded up and down and back to the middle, which one would look at and say, okay, well, this is the market doesn't know what it wants to do. Yes, it doesn't know what it wants to do directionally, but what it is suggesting is everybody's happy with these prices. People are happy to say that this is really the area that you want to trade. Somewhere between around about 29.50 and 29.15 is around about the price that you can pay. If you want to buy the pound, if you want to sell the pound, that's the area where you're going to be able to most likely and most able to get filled. You're going to struggle at the extremes, volume will then taper off. So that's all good. This is where everyone's happy to trade. The next day, similar start to the day, and you trade in this little range here, similar kind of concept. Most people happy trading in a range, market can't sustain a move in either direction. We once again are quite comfortable that that's where value is established. But late on in the day, you then get this very, very directional move. People's perception of value has changed, at least in the short term. And this is the important thing here. You've had 2 days where people are widely happy with value, widely happy to trade in a range that has deviated slightly higher. So you could now suggest that it's somewhere between 15 and 65 is where people deem good value to buy or to sell the pound. Price moves up. Now, this provides a question. Do you want to buy now that price is up here? Or are you responsive to this and view this as price being too high based on where value currently is and are willing to sell? This is what's going to bring sellers in. So they're going to look and go, well, that was good value there. Price is up here. I'm definitely going to sell now. And this is that idea of an advert to trade. This produces a pretty solid looking candle because you're going to have an open down here and a close up here. So you get this very, very solid green candle with a tiny wick at the top. From a candlestick basis, that is a really strong move. But from a profile perspective, if you look at where value is, it's very much not. Value's been left lower. So one of two things need to happen. Buyers need to come in and respond and maintain price up here, or price is going to get driven back down as sellers come in, respond to those higher prices, start to sell, buyers don't step in, price is going to get dragged. Excuse me, price is going to get dragged back to value. Remember, a move isn't sustainable unless value moves. And this is what happens. We have the next day of consolidation. And what this does is it allows buyers to come in. It does shift value up. It doesn't balance value very well. So that's one issue here. Remember, this was the day where you didn't get that shift in value. This is the back end of that move. So you have this kind of uncertain day. What's going to happen here is buyers are willing to buy on these dips. So they buy as we start to deviate back into this range. This provides a bit of support, market moves slightly higher. Now, that advert to trade that has brought buyers in clearly has in a sense succeeded. This has brought in some buyers that's maintained price higher. So now you have a situation where you had buyers here that ultimately were paying a high price compared to what the price was, followed by new buyers who have come in and are willing to still pay a high price. This then concentrates positions higher. If they don't get movement now, don't get further directional movement, there's now a lot of people who are essentially stuck. They're expecting movement higher. They've reacted to that advert to trade by buying. If they don't get continuation, they can then get forced out of their trade. And this is what then happens. As soon as you break the low of this range, you get a very fast drop, pull back, continuation move, market goes straight away back to value. Now, we're not going to focus too much on precisely how you execute this for this part, where we're looking at basic principles, but the basic concept is here. As soon as you fall out of this range, there's your opportunity to get short. And this is what I mean by providing a framework. It's not saying you have to sell it here. There may well be opportunity in other areas. There may well be opportunity after the move is initiated. But the idea is that you can understand why we're going to go back down there. And it enables you to move past the just simply looking at this as, oh, there was trade down there, now we're up here, we're not going back there. Whereas looking from a value perspective, you can see now the market is going to get dragged back to value. If people aren't willing to accept this as value, well, the next place that people are willing to accept value is down here. The market's going to move straight the way back there. That's the concept of an advert to trade, a market that can suggest you have prices to trade at, but without the movement in value, it's not going to sustain. Okay, so we talked about in those three questions, asking yourself about how well the market is doing at what it's doing. I'm going to give you a couple of examples here. First one, just to illustrate. You're judging how well a market is going about its business by considering the movement in value. So I kind of try to step this through. Your assumption should be that whilst value continues to move in one direction, the move is sustained and you can expect the move to continue. Now, as I'll show you here, things start to change and you can start to then add information to value to try and understand really how well or how good a job the market is doing. Now, the first thing to look for in terms of value is to look for the amount of overlap. Now, in days 1, 2, and 3 here, there is almost no overlap at all. They're completely separate in terms of value, and value continues to move lower. So in that respect, this is looking good. Even though this is a market where it doesn't close very close to the low, it does on day 1, it doesn't on day 2, and it doesn't on day 3. And those closes are important, but ultimately they're overridden by the fact that value is continuing to shift lower. Day 4, value continues to shift lower as well, and we get a marginal overlap just in here and a close lower. That's still maintaining the move. The one thing to question in this, and we'll talk about the quality of a value area soon, is this is very balanced. That's ultimately what you call a good quality value area. But in terms of maintaining a movement, it perhaps starts to bring into question this move. On the way down so far, balance has not, or value has not been massively balanced, which suggests that there's still control of sellers. Sellers are still having to move price in order to find liquidity. Here, it would seem that they may have found it. So you start to see the story of how well the market's doing change. It's becoming more balanced. You could suggest that the move is perhaps tiring slightly. Now, point 5, what we end up with is value completely overlapping. All of a sudden, this should be raising questions, making you doubtful of the move. You've seen one day where value stayed very balanced, and the next day where value was completely overlapped. Can the market really sustain this? Because what it's showing you is there is an even amount of buying and selling here. You found the responsive buyers ultimately, and sufficient numbers of them to prevent the market continuing. So this is the first point where you start getting some doubts come into your mind. This is building the story up as the move goes. Day 6 then, value does deviate lower, but the majority of volume is still within this day's range. And what's quite significant, what's quite significant about this, and we'll talk more about this in terms of completing a move, is the tail. Look at the number of prices that are traded outside of value compared to what you've seen on previous days. This is showing you that value is staying towards the high. So for a market that has managed to fall, value staying towards the high is an indication that this is now quite possibly the end of move. To this end, you can go into day 7 looking at something like that, think to yourself, if this starts to move up and for the first time breaks above previous day's value, this is now the chance to then try and play this market to the upside. You finish the move off potentially here. And in terms of how well it's doing, good, okay, not very good, bad, potentially turning. It's about building that story and seeing that shift as the market comes on. It's about ultimately adding more and more information together. And as we start going into mapping days and weeks out, we'll then start to build up the sort of informational story as something like this occurs. To give a further example, and this is a slightly different scenario here, where rather than value shifting lower and then ending, this is a situation where you start to see value puts in the first shifts down, which opens up the possibility of a move lower. But on that move lower, fails to move value completely. So this is moving gold, and I'll show you this from a candlestick perspective in a moment. What we're having here, or what we've got here, is a market that has moved higher very clearly. So we've opened down here, closed up here, wide value area. We've then got a tighter value area entirely inside the previous, and another value area entirely inside the big one again. So this all sort of balances out and shows acceptance at these prices. We start then getting more compressed value, and the more compressed value starts moving down towards the bottom of this range and further. So what this is doing is this is essentially forcing trade lower. People are now starting to accept that even within this wider range, prices can move lower. They move them down ultimately to an area of support, which I'll show you from a candlestick in a moment. This then opens up the possibility of a market falling away from balance and accelerating down. It becomes very obvious when you see this on candlestick in a moment. But what it doesn't do is shift value. Think about that previous example. VPOC is left at the top, that's this pink line. Value on the whole is in the upper half of the range. The next day, we do accept value lower, but there's always going to be a doubt if you move above the range of this day, that we get pulled back to where value was left and where value slightly deviated lower without really driving lower. So this is the idea of value shifting. You've got to look at how value's moved relative to the entirety of the movement. What is that indicating for you? What is that showing you about what may or may not be coming next? This is what you get when you look at it from a candlestick perspective. So those 2 days, these two here, where you have a lack of value on the 2 blue arrows, shift to value lower, I said lack of value, not a lack of value. 2 days where value does shift slightly lower, or at least compresses towards the bottom of range. And these 2 days here. Now from a candlestick perspective, this starts to look quite obvious now. Where the profile is helping you out is understanding that now you are starting to see more acceptance lower down in these little ranges here. And this is what's dragging the market down, adding weight. So you're now looking at it thinking, okay, great. We can look for a break towards the downside and potentially take back the entirety of this move all the way back down towards sort of 15.15. Oops. Down to this level down here. That's what you can be looking for. Now, remember, the move down didn't shift value. Market dropped, but value stayed up here, up here. This is what then suggests that there probably isn't that much more in this and strengthens the levels lower down. If you look at what we've got here, whilst you may well have been looking to the entirety of this move to get reversed or retraced, you've had a previous high. The move back to that with no shift in value creates a rather strong level. Because unless you're getting people willing to sell down at those prices, the point where people could well be willing to buy is much more notable when you run out of sellers down there. It's so much easier for buyers to gain control. You need very few buyers to stop the market, and you've then got this kind of weight of buyers, or army of buyers below that, who all now have to surge forward, move their prices up in order to drive the market back up, or in order for them to get filled. Often I think people would use, and I just did it myself there, use the wrong kind of, in a sense, terminology. People are not looking to drive the market up. The market is driven up by people looking to try and get filled, people looking to try and enter trade. And as they try and enter a trade, they naturally have to push the market in order to find somebody who's willing to sell to them. You need to buy, you need to find a seller, and as such, you need to move your price up until you can find somebody who's willing to sell to you. Now, we talked about value, advert to trade. We're going to look here at value versus price. Because what we've got here, and this is Bund. The previous one was gold. Previous to that was S&P. This is a Bund example. And what we've got here then is 3 days of balanced value. Everybody's happy. Prices are all in the same area. Market's balanced. You then get a move lower. Value shifts lower. Price moves significantly lower and closes below value. Now, what this suggests is that you do have a market that is willing to come off. This day here is this day over here. But this is a market that has stretched the price out. And as a result, you now need more trade at lower prices in order to sustain this move. You need acceptance down here. So what this would suggest is that with the absence of value shifting in line with the close, you're now in a situation where we need to see value built lower down before there can be a continuation movement. As such, you can expect this day to be a quieter day, a day that is perhaps more rotational as people try and work out where exactly value is. You also run the risk that if we start to deviate back inside the previous day's range, the obvious point to target is then the bottom of value. This is where people are happy to trade, and so the market can then get sucked back to it. So that's the way you might want to think about this. The more time, the more volume spent down below the 174 level in Bund, the more sustainable the move. But any time that you get above there, you've now got the scope for the market to get pulled back up. It dragged back to value because of the fact that if people can't recognize value down here, they must recognize value up here, and the market will then run towards it. Imagine you're a seller. You're happy to sell down at these prices. Now, if suddenly you find that lots of people are willing to buy, where's the next place that you deem value to be? Up here. So you move your offers up. As such, there's very little space for buyers to come in, or there's very, very few people that buyers can buy from, and price will then gravitate higher. You'll get this surge up movement straight the way back to value. And that's the difference between value and price. And this is the result you get. It could well stay a bearish day. Drag value down, maintain the movement. But once you get inside the previous day's range, and even more so once you get inside the previous day's value, you've now got the possibility of further movement higher. And ultimately, where was value? The previous 3 days, all the way up here. So this is your corrective move, back up. Market can't sustain down, and the market then corrects itself back up. Takes you back into the previous range. This is where value is accepted, which now suggests that this has been a move lower, which is not necessary, not sustainable, and the market then continues towards the upside from here. So that's the idea of value compared with price. Okay, in this next section then, so we've looked at auction theory, we've looked at different kind of concepts about how people transact and the movement in value. We're now going to look at markets becoming directional and non-directional, so the balance versus imbalance. So the kind of things that may well happen on a day-to-day basis and your interpretation of specific things. So rather than looking at the shift in value and the kind of overall perspective, we're now going to look at specifics. So specific things that you might see within a day, specific interpretations of certain types of value, interpretations of certain reference points on a profile. So one thing that a market will do is it will shift from balance to imbalance. Now, this doesn't mean that every day you have balance, you must naturally get imbalance the next day. A market can balance for 2, 3, 4, 5 days. It can balance for weeks. The euro dollar, for example, going into the end of 2021, essentially traded in a balanced range throughout the entirety of November and December. Very muted market. It's entirely balanced, and this builds up positioning. It builds up energy. And that's the way to judge any kind of balance. Now, balance can be one day, or it can be balanced across a much wider range, in which case you will get short-term kind of trend type moves within that, but ultimately over the long term, value is going to accumulate in the same area. Like I say, this implies built up energy, because for a market to balance, you need to find an equal number of buyers and sellers. So they build their energy up. And when I say energy, what's happening is people getting into positions. Someone's going to be wrong if you're in a range, and when you break the range, whoever's wrong is going to have to trade away, trade out of their trade. Also, those who are right now can start to enter. Those who are waiting on the sidelines get confirmation of what's going on, and they too will then start to enter trade. So what will happen is you get this initiative move. And what's so key about this, and the way that you need to always be thinking about balance, is when you see a market that's balanced, you can't assume that it has to imbalance the next day. But what you can assume is that at some point it will. And what you're looking for is initiative. You're looking for something to change. And at that point, you've got action. So you're looking at the points where you've had previous responsive trade and the market's traded down and back up, traded down and back up. At those points, at the extremes, you're looking for a change. You're looking for the market to trade in a different way, more volume, more pace. When you see that, that's now saying to you, this can imbalance itself. And as the market imbalances, you will then get directional movement. And what will happen is you can end up with essentially what becomes a trend day. What happens? The market will move outside of value. It will move outside of previous range. And you will then get responsive trade. The market will move and bounce back a bit. Now, when this bounce back is met by equal responsive trade and a continuation of initiative, the market will continue to move. This is where the imbalance comes from. So you'll end up with a market that essentially moves down, response, response, initiative, response, response, initiative, response, response, initiative. And this is the imbalancing of a market. The market now hunts new value. And we need to then establish value at lower and lower prices in this instance before you can start to find sufficient buyers that are going to stop this move continuing to the downside. So this is what you get. And one clue to a potential imbalance is going to be a failure to imbalance one direction presents the possibility or the greater possibility of imbalance in the other. This is an example using the pound. In fact, it's not the pound, it's the euro. So an example using the euro. What we've got here then is a market that, and if you look at this, remember from a profile perspective, puts in 1, 2, 3, 4, 5 days of balance. Value doesn't shift. You have had a day here where the market trades up and we close way out of value. Value's unmoved, market opens, trades straight away back. What this is showing you is that given the chance to go higher, having found some initiative and enough initiative to unbalance the market, to tip it in one direction, allow directional movement, it's not found continuation. It's not managed to shift value. And so therefore, it gets dragged back because ultimately, from a value perspective, this market hasn't imbalanced. Price has, directional movements happened, but the market's not imbalanced and so therefore gets dragged back. But what this shows you now is that buyers aren't strong enough to maintain directional movement. And with that in mind, you can now have much more conviction that if buyers are defeated at the bottom of this range, where value is clearly established, there's your bottom of value for the range, and then your obvious bottom of range. Once they're defeated, then the market can imbalance and strength is going to run with sellers here. As such, you're looking then for a market that puts in these sort of what I call a broken profile that is far from any kind of balanced bell curve, and instead constantly drives value lower. This is what it looks like in terms of your actual candlestick chart. What you end up with is, this is your initiative break, which, from a candlestick chart looks like probably the strongest move. It's the biggest green candle, some decent volume. That looks like a very strong move, but the lack of value shift is what drags us back down. Once you get the counter move and the imbalance, it doesn't necessarily look like the strongest of moves, but it shifts value and you get this relentless selling pressure. That goes to imbalance the market. That does tip it over the edge and maintains the directional movement. This drags value lower, and the next day after that, we start to balance. You start to find acceptance down at these prices. Remember, markets will move from balance to imbalance and back. Once the market's imbalanced, now needs to find responsive trade to balance the action out. So what I've got here then, to try and illustrate this a bit further, is to actually look at this over the course of 4 weeks. This is a movement in the Bund, and this is the idea of seeing value or seeing a market balancing and imbalancing, not just on a day-to-day basis, because one could argue within this 2-week period, very clearly that is not a very balanced day there. You have a move up and a very clear move lower. Whereas prior to that, you've got a very balanced day in here. And then you've got equally balanced days in the middle of ranges here. You've got small move higher, small move higher, small move lower. Ultimately, the market over the course of the 2 weeks is very balanced, and you can see that from the profile just over here. So price is accepted. And this is where your kind of medium time frame participants are much more prevalent. They're building position. They're happy to trade. Buyers are going to be trying to buy as we approach the lower end of the range, sellers as we approach the upper end of the range. Then we get new initiative. Perspectives change. Perhaps an other time frame seller comes in who needs to now sell. And this then is what drives the market. You get over the course of the following week, very broken value. If you look at the value here, rather than being nice and balanced at the beginning of those previous 2 weeks, values constantly, little peaks of volume all the way down. This suggests imbalance. This is a market that constantly is searching and searching and searching for new value. And each time it finds it, you get a further step of the move. Take this day in here, for example. We open here, surge down, pull back, little balance. That's what creates this bit of the profile where you have value higher, drive down, value shifts lower, which is that move there. And that will continue. And it does so into the following week. You see the same kind of thing, bit of volume done here, no volume, bit more volume, no volume, lots more volume. Now you're starting to see acceptance. You're starting to see a willingness to trade at these prices. Now that doesn't mean that the move is over, but it means that the market is starting to balance. It's slowing down. You finally got to a point after this big sell-off where you are finding an equal number of buyers to sellers. This then balances the market out, which effectively puts the market in a position where it can now go either way from here. It doesn't have to go up, it doesn't have to go down, and you're waiting for the next leg of the move. It could end up widening this range and turning into something like this. And you then essentially establish value, direction, value would be another way of looking at this. So it's about then using this information. You see that the move is stagnating, which suggests you're now going to see more two-directional rotation up and down type trade. So that's the idea of how value progresses over time. You need to think about with any kind of movement in terms of being able to maintain directional bias. And that's ultimately what you're trying to do here. By understanding how value shifts, you're able to understand directional bias, you're able to maintain directional bias. As long as you're seeing value continually shift, you assume this is going to keep going down. You can assume it's going to keep going down on this day, in which it does, and on the next day, but it doesn't. This is now starting to give you a clue, and the following day, it doesn't. This is now starting to tell you more. Starting to tell you that, okay, you can't continue to play this to the downside because you're not getting the payout that you were seeing. Now you need to change your perspective and open up to the possibility of reversal or the necessity for new initiative to maintain this move. Okay, you will also have the opposite of this, where you will get balance after an initiative movement. Like I said, for any kind of move to stop, you need to see counter trades, you need to see responsive action. What's so important about a move like this is not that it's about sort of saying stuff, right, well, how am I going to trade these balance days? It's about managing expectation, particularly on a day-to-day basis. That what is typically going to happen, it's a very common thing to see, that when you get a very clear directional move, an imbalancing market, a market that drives in one direction, you get that, and what will happen here is typically after that, the market needs to take a breather and balance out. So what it enables you to do is the following day, after having seen something along the lines of this, where you get very, very clear straight line trend type move, this is an example in the DAX, the following day, you can be looking at this thinking, there's a reasonable chance that we're going to balance out. So the market has come a long way. Are people still willing to buy? You know, think about it from a trader who was thinking, yeah, I quite want to buy down here at 12,280. And now the price is 12,500. Now 220 ticks higher. Do they still want to buy? Are they still going to be willing to pay high prices and continue to drive the price higher, continue to pay up? Or are we going to run into a situation where you are going to find sellers? Because somebody who thought it was a good idea to sell down here, surely now thinks this is a much better place to sell. So you're going to find sellers. Any buyers can take a break. The work has been done to get it here, if you think about it like that. and they will then step back and essentially step back and say, okay, well, if price drops down, if the market starts to fall, we'll buy it. We'll pick it up on a drop. So they become responsive, which is why you then start getting the trade down here, market then pulls back and then starts to accept trade at these prices. So that's what's happening there. And that's quite a typical thing to see. It enables you to, to maintain your overall directional bias because nothing changes here. But it allows you to manage expectations. Too often people get influenced by the first directional move. They see big move and they assume you're going to get more of the same. Often you're not. Often you will get this balancing type phase. Think of it as somebody running a marathon. You're not likely to get somebody run a marathon and then be able to suddenly get up and run another one. Of course, there's exceptions and you will have days where you get this drive, but that's quite rare. People need a breather. People need to take a break before they can go again. And that's what's happening here. People are reassessing. They're deciding whether there's still justification to keep on buying in these areas or whether this is more a situation where you can step back, wait for the market to then start to come back. So what you're looking for is to then start trying to buy pullbacks. You're aligning yourself with what other people are doing and you're starting to wait for the market to fall back. Whereas on this day up here, you've got to be aggressive. You've got to be trying to buy as it breaks higher and continue to sort of add and add and add. Here, you know what you need to do. You need to step back. On the rare occasion that it does go again, even if you step back to start with, chances are you're still going to be able to get into a trade. And then as it starts to gravitate higher and shows initiative, you can add again. You can keep that, you can keep on playing it in the way you did the previous day. It's all about understanding the nature of the movement, the likelihood of balance after imbalance, and then how you can play that whilst maintaining a bias, but managing expectations. You can't buy this here expecting it to drive for another 200-300 ticks. Instead, you can get above the high of the day. You can be reasonably happy with that and reasonably comfortable to think, yep, that was a good move, I'm happy. Another example is the gold one. And what ends up happening here, this actually occurs over 2 days, but what I want to talk about predominantly is what happens on the balance and what's actually occurring there. What you end up with is you get this sustained one directional move. We talked about where you could place your trailing stops and you get these types of moves. We create a low, we break, we pull back to it, we break again, and so on and so on. And so you get these constant sort of reference points as the market drops. And within the move, and you can see this within 1 day, within this move, what you've got here, and this is like that move in 2 weeks in the bund that we just looked at, but within this move, you will then see value start to accumulate lower. So we start to balance. There's the first sign of acceptance down at these prices, the first sign of a breather. So you go into the next day straight away with an expectation that the market may well balance this out. As such, you're going to be looking at any counter trend move as a possible sell. You maintaining your bearish bias, maintain the idea that you can respond to this big sell-off by trying to sell again. So anything that moves back, clear previous reference point, you can have a go at selling. Market moves back down. Now, what's distinctive about the more balancing type days is rather than move back up and sell off, which is what many will look for, and many will look at this as a kind of flag or pennant type formation and view this as a chance to then play this down, particularly if you view it as a flag rather than a pennant. You don't get that leg down. What you generally get is lower volume, certainly compared to the previous day. And you get a situation where any move down gets rolled back up, 2-directional trade. This is just where people are taking a breather. By maintaining that expectation and sort of being able to say, okay, I don't expect it to surge through the low. So in terms of thinking about it from a tolerance perspective, like we talked about with entry and exit, you're going to be looking at this with a reasonably low tolerance to staying in. You're not going to want to hold on to this unless this puts in a huge amount of volume and really drives lower, something like this type of movement. Unless it does that, you're not going to want to stay in this because your expectation is already set that this is a market that is much more likely to balance than it is to drive onwards. For that reason, you're then able to manage that and you're able to look at it and go, okay, somewhere below the low, anything that breaks this low, you can be happy to get out of that trade. And you see this is what I would describe as an unconfident market, a market that doesn't really know what it wants to do. If you go and look at the prices, I think that, we can all deduce this anyway. This was looking at oil in April 2020. Very uncertain market. We were coming out of the pandemic. No one quite knew what to make of oil over this period. This is a market that essentially was generally ruled by shorter time frame traders. People didn't hold on to positions because nobody knew what the next day was going to bring. As such, you end up with a market that becomes directional one way and balances out. Nobody's sure what to do that day. You then get directional back the other way, balances out, followed by direction back again. This is a market that has no idea really where it wants to go. So you move in these little phases. This is the first balance after the move up. Then you get this very, very straight move down, followed by another balance day, which is over here, and then a reversal type move. It's a market that doesn't quite know what it wants to do. Very, very uncertain, very unclear. And it's this constant sort of push-pull between short time frame traders that you see on these types of days, or you see over these types of periods. Market lacks confidence. Normally, you would be looking for directional move that then balances to enable the market to become directional again, to maintain that direction. Of course, it doesn't have to, but the fact that it's sort of drives one way, balances, drives back, balances, starts to go again, suggests a market that really doesn't know what exactly it wants to do at all.